This is Michael King, and now we're going to start looking at our first financial security, which are bonds. In this first set of 3 videos, we're going to look at what is a bond, what is debt actually, and how do we find out the price of a bond. Within the book by Booth, Cleary, and Rikita, we're looking at sections 18.1 to 18.4. So, as you recall from your accounting class, looking at a company's financial statements, we have assets that generate value for a company on the left, and we have liabilities and equity on the right. Liabilities and equity are the two sources of capital that are used to finance the assets, and so we often call this capital structure. Within liabilities, we have current liabilities, which are payments that are due within 1 year to suppliers and other creditors. And we have long-term liabilities, which may be deferred taxes and other liabilities that are longer than 1 year. But we also have a category called debt. And there are many different types of debt, which could be actually short-term as well as long-term. By debt, we mean money that's been borrowed by one party, who is called the borrower, from another who is called the lender or the creditor. And critically, debt pays a rate of interest, either explicitly or implicitly. So debt is actually a type of contract from one party to another, and that contract, which is set out in a type of agreement, could be a loan agreement, could be a bond indenture, sets out the terms of repayment. There are 2 types of payments that have to be made. Payments of interest, which may be called interest expense from the company's point of view, but it may be termed coupons or interest income from the point of view of the person who is receiving it, as well as the repayment of the amount of money borrowed, which is called the principal amount or the face value. Any failure to pay interest or principal when due can lead to an event of default, allowing the creditors to seize the assets of the company. So debt holders have a higher claim in bankruptcy to a firm's assets than equity holders. As seen in this picture here, you see that debt is higher up on the right than shareholders' equity. Debt is therefore considered less risky because the chances of getting repaid are higher. But it's important to know that in exchange for this higher claim and this lower risk, debt holders are not owners of the company. They don't have votes, votes are associated with common shares and shareholders. So debt holders are able to exert control, but only indirectly through the terms of their debt contracts. And these terms are usually referred to as covenants. Covenants are restrictions on the debt that they limit what management or the borrower is able to do, such as ensuring that they have enough cash flow to pay the interest expense, which is called the interest coverage ratio, or they may not be able to sell additional debt that has a higher claim on the assets, which is called a negative pledge. So debt is a form of liability, but is different from other types of liabilities. Debt actually pays a rate of interest. So there are some securities or some instruments on the company's balance sheet that you may not think of as debt, but are treated as debt by accountants, such as finance leases. Revenue tax authorities, such as Canada Revenue Agency, will actually use different tests to see if something should be called debt. In Canada, we have 3 tests. Interest is paid on the money that's borrowed. Interest expense is calculated relative to some face value or principal amount borrowed, and the interest accrues daily. The reason this is important is because the tax code allows debt or interest on the debt to be paid prior to the calculation of taxes. So it's paid out of pre-tax income, which is sometimes called EBIT or earnings before interest and taxes. So in effect, the tax code is subsidizing the cost of debt and reducing it effectively by 1 minus the tax rate. So there are different types of debts. We're going to classify it in several different ways. The one classification is whether it is marketable or non-marketable. Non-marketable means it's directly borrowed from a bank or other creditor in the form of, say, a term loan or revolving loan. Marketable debt is debt that actually trades in financial markets, and in particular in the bond or fixed income markets. It could be bonds if they're longer than 1 year maturity, but it may take another form such as commercial paper or bills if they're shorter than 1 year maturity. So the second classification is how long until the debt has to be repaid, which is called maturity. And there is a big distinction between payments that have to be made, debt that has to be repaid less than 1 year versus longer than 1 year. And accountants tend to distinguish between what they call current liabilities, which is less than a year, and non-current. But financial analysts and creditors will distinguish securities called money market securities, which are less than 1 year maturity. When it comes to bonds, they will call it a note if it has a maturity of 1 to 10 years, and they reserve the term bonds for anything longer than 10 years. So debt is also classified by the type of borrower. There are many different types of borrowers. We know that governments issue a lot of debt, as well as in Canada, the provinces or even municipalities. You have many different types of corporations that will issue debt. They could be manufacturing businesses, energy and gas, utilities. Another big classification is financial institutions, such as banks and insurance. And there are many different types of special purpose vehicles that can be used to issue debt, such as asset-backed securities or mortgage-backed securities. Of course, individuals can also take out a loan or take out a mortgage, but we're not really going to be concerned with retail or individual debt in this course. One way to classify debt, once you know who's issued it, is to look at whether or not there's collateral or assets that are specifically attached to the repayment of this debt. So, for example, when we talk about mortgage debt implies that there is a piece of real estate that's behind this loan. Similarly, an auto loan would be backed by the physical auto itself. If debt does not have collateral attached, we call it unsecured, in which case it has only a general claim in the event of bankruptcy. So bankruptcy is a key thing when looking at the risk as well as classification of debt. And we talk about the level of priority in bankruptcy, who gets paid first. Some debt may be called senior or unsubordinated, which means it gets paid first, with subordinated debt or junior debt paid second. Now you can have senior secured versus senior unsecured, so you can combine collateralization with priority. Okay, so here's different types of both marketable and non-marketable debt, which is short-term versus long-term. So an example of non-marketable short-term debt would be a line of credit, such as an overdraft facility that's less than 365 days. Whereas a form of marketable long-term debt would be bonds that are sold by a company to investors, institutional investors such as pension funds, mutual funds, or banks and insurance companies may also buy them. Now note that bonds may also be called notes or debentures. Those are two other terms for bonds.